You are listening to The Investor Way with Sam Ball and Jonathan McEwen. If you enjoy the show, please subscribe and follow us on Twitter at TIWTweets.
Hello, welcome to the Investor Way with me, Sam Ball. It's the 22nd of October 2024, and I'm joined today by my co-host John McEwen. In this week's episode, we'll be discussing Louis Vuitton, Whitbread, ASML, Mony Group, Nestle, and our US company of the week is Netflix. So, John, do you want to start us off with one of our three European companies this week?
Absolutely. So it's LVMH. It is a favourite of the show. We've introduced it many times before, but it owns a portfolio of very high-end brands: Moet Champagne, Hennessy, Louis Vuitton, Dior. But they've got a huge portfolio. Bulgaria is another one that you can view on the investor relations page of their website. Anyway, the group had a Q3 trading statement out this week with LVMH's third quarter organic sales falling by 3% to 19.1 billion euros, which was missing market expectations of 20.1 billion euros. The fashion and leather goods division, which accounts for nearly half of total sales, saw a 5% decline as falling volumes more than offset increased prices. Wines and spirits continues to see the largest decline, with performance held back by weak local demand for Hennessy cognac in China, and the perfume and cosmetic sales were actually positive, up 3%, with strong performances in the Christian Dior brands. LVMH referenced the current uncertain economic and geopolitical environment, but said that it will remain focused on enhancing the desirability of its brands. And the shares fell fairly heavily, nearly 7% in early trading following this Q3 trading statement. In terms of valuation, LVMH has a market cap of 313 billion euros and trades at 20.7 times forward earnings, compared with a 10-year average of 23.5, and has a prospective dividend yield of 2.2%. I mean, these results are clearly disappointing. Historically, and since we've been doing the show, it has been performing strongly in what have been difficult macroeconomic circumstances. I think you are beginning to see things catch up with them a bit, and that valuation has come down accordingly. It's still not cheap, but I think if you took a long-term view with the company, it's still very positive, and I think it's the best company in the luxury goods sector. Valuation, it's difficult because I think a company like this, you're never going to get it really cheap. It's incredibly high quality. Whether it becomes cheaper, I suppose that is, the $1 million question. I would wonder, if it stays around this, and if it fell any further, I would personally wonder about whether I start a position in it, because we haven't seen it this low for some years. So I think it's potentially attractive, but that's assuming that things do, begin to turn around, and obviously the longer term prospects with it. That's probably where I would leave it at the moment. So it's quite high up there on my watch list, and I'll be keeping a very close eye on it. Sam, what are your thoughts on LVMH, these results, and its longer term prospects?
So I kind of vaguely recall the last time we covered it. I think the results weren't as good as they'd previously been either, but I think it was just slower growth. I don't think it was actually a drop. I think in the long term, it's probably not going to be a huge issue because the quality of those brands and the number of those high quality brands is unbelievable, really. I think having seen these results, maybe I'll go in a little easier on Burberry next time we cover it, because they've also been doing poorly. Although even still, these results are not as poor as Burberry's were, which again, I think is testament to the quality. But it does show the market generally, I think, is having a bit of a wobble at the moment. I agree that it's a fantastic business. I agree that it's got some fantastic brands, and they are brands that I think most investors would probably absolutely love to own. But at these figures, and bearing in mind, I know it's put up some really impressive growth in probably the last 5 years, but it's a kind of business where I could see it growing above inflation And I think they've got that capacity to keep raising prices every year. But I do wonder how much. I think it'll outpace inflation, but can I see them sustainably raising prices more than 10% a year? I don't know. So, and some of these brands are already quite saturated. And I know you've got, like, for example, the emerging Asian middle class and stuff, which could make a difference. But I just think with these figures, I'd want it at quite a bit cheaper than 21 times forward earnings. I think it's still got a way to drop, but that's assuming that this is the start of a bit of a longer wobble. Whereas if it just bounces straight back, you're probably going to look at it and say, well, that was your chance and you didn't take it. So, but if you get another, I think, half or two like this, I think you'd expect to get it lower than a forward P of 21.
No, fair enough. So you won't be buying shares at the moment. Would it be one for the watch list?
Do you know, it's a difficult one because it's not the type of business I'd normally buy. I tend to prefer more growthy stuff, but the brands are just so good. I actually think there is there's a price at which I'd probably buy most businesses, but I think for this one, I think if it dropped to, and I don't actually think it will. It would have to really carry on wobbling. I think if the PE dropped to about 15, I'd probably seriously consider it. But that's more because of the opportunity cost, because I'd normally go for something a bit growthier. Whereas for someone who likes these kind of income plays and doesn't mind paying a premium for such high quality brands and wants something more defensive, the price might be more like 17 or 18. But for me, it's probably about 15.
Fair enough. Okay. Is Whitbread growthy enough for you?
It's an interesting one because it's definitely more growthy than maybe we would have first thought when we first started covering it. So we've covered it multiple times. Whitbread, the hotel chain, it's basically mainly the hotel chain now. Used to have Costa. We used to have loads of stuff actually, but got rid of it all. So mainly just the hotels. They have come out with their half year results, and first half revenue was unchanged at 1.6 billion, with Premier Inn revenues down 2% due to factors including lower hotel occupancy and restructuring of the food and beverage arm. German accommodation sales increased by 22%. Underlying operating profit fell by 7% to 413 million due to a softer UK hotel market and disruption from the changes implemented at the restaurants. The lower profitability drove a 17% decrease in free cash flow to 293 million. Net debt, including lease liabilities, was 4.5 billion. In the first 6 weeks of the second half, UK accommodation sales fell 1%, with food and beverages falling 14%. By 2030, Whitbread expects to add at least 300 million in underlying pre-tax profits and generate 2 billion of capital to allocate to shareholder distributions or suitable investment. Whitbread raised the interim dividend 7% to 36.4p and launched a 100 million share buyback, and the shares were up 3.9% in early trading. Expectations for a 3 to 4% inflation on the UK cost base remain in place for the current financial year, and a further 150 million of cost savings have been identified to be delivered over the next 3 years. And it's worth noting that the group owns over half its hotels rather than leasing them. And its reinvestment plans of around 600 million for the current year should be fully funded by cash flows and disposal of non-core assets. In terms of the valuation, of business trades at a forward price to book of 1.5, and that's compared to a 10-year average of 2. And the PE is about 16. The prospective dividend yield is 3.4% in the next 12 months, and that compares to a 10-year average of 2.1. I think these results are somewhat disappointing, but I think within those results, the German figures look very good. I think there's a lot of runway in Germany. We've covered it before, but the German holiday market is very fragmented. There's not really the dominant big players like the Premier Inns and the travel lodges that you have in the UK. So there is a good opportunity there, which we've discussed more in previous episodes. So yes, I think the German figures at 22% is good. I don't know how I feel about this, but I'm not thrilled with raising the dividend 7% and launching the share buyback, just because I think they've got these investment plans for Germany, and I think there is a big opportunity in Germany. They've put up some absolutely monster figures in the last sort of 12 months, which is probably why these results are a bit more disappointing, because they are up against really tough comparatives, because for the last year, they've just done fantastically well. They really have. And even since COVID, actually. But yeah, so I think management can probably better invest the money better than shareholders at this point. I think they've done such a good job that if I was a shareholder, I wouldn't want a dividend and I wouldn't want a share buyback. I'd rather they pump that into the German operation. I will maybe let them off because it did mention that they've sold non-core assets. So it might just be that they're just distributing that and the actual cash flow generated is still mainly being reinvested. But even then, the 7% dividend increase, if I was a shareholder, I'd be very happy to leave that money in the business for management to reinvest in the German business. But yeah, I think it's a slightly disappointing half, but that is on the back of, it's up against some really tough comparatives. And I think the German side of the business, which is what I would be mainly concerned with as a shareholder, given that the UK is already pretty saturated. I think those figures were very good, which would be the main thing that I was concerned about. John, what about you?
Yeah, I mean, pretty similar. It's obviously been putting up the numbers, and it was a remarkable recovery since COVID. I think we'd probably written it off with a lot of other businesses in the sector. Slightly disappointing with these results. And I suppose valuation wise, I think it's probably fair. It is all based on what's going to happen in Germany. But equally, even then, it's not that expensive. And I think you commented on it before when we've covered it, but it's not like there's been huge consolidation in the German market. So it is kind of right for Whitbread to come in with, Premier Inn. And I don't know whether it's going to dominate, but even if it, continues as it has been over the next few years, then I think that valuation probably does look on the cheaper side. I take your point on the dividends and the share buybacks. I think that's fair enough. Be interesting to see. I don't think it's top of my list, but it certainly has been performing well and absolutely wouldn't be one I'd bet against.
Well, I think the issue for me with Whitbread is it's in a really, really unattractive industry, but management can't do anything about that. And I think for the industry they're in, management have done a fantastic job in the last 3 or 4 years. It's kind of like when we look at, for example, what's it called? The one with Sunbelt Rentals. I've forgotten the name of the parent company.
Ashted?
Yeah, it's like when we cover Ashted, where they've obviously the company behind Sunbelt Rentals. Very, very good operator, market leader, sort of doing everything right in that industry. But it is just it's a low margin and for me, very unattractive industry. And it's quite similar where I think, the management are doing a really, really good job, but I just wouldn't be interested in any business in that industry. I know it's kind of like when we were talking about, was it Chewy the other week? It's like,
Yeah.
would you want to own the best airline?
Yeah.
Because I
Yeah.
probably still wouldn't. And I think that's the issue with Whitbread. So should we move on to a debut on the show?
Yes, so ASML, which stands for Advanced Semiconductor Materials Lithography, it's a Dutch company and they had their Q3 results out. Essentially, what they do, and I'm going to try and explain this in about 10 seconds, but we can go into it a bit more later, is it makes the photolithography machines that are used to manufacture semiconductors. So it's that technology essentially that the company is responsible for. And as I said before, they're Dutch. They had their third quarter results out with sales up 11.9% to 7.5 billion euros, which was ahead of previous guidance, with double-digit growth in both service revenues and system sales. Order intake was flat at 2.6 billion euros on an annual basis, but more than half of prior quarter levels. Operating profit grew broadly in line with sales to 2.4 billion euros, and free cash flow fell from 618 million euros to 534 million euros due to lower year-to-date order activity, as well as an increase in inventory levels. Fourth quarter sales are expected to land between 8.8 billion euros and 9.2 billion euros, helped by the first sales of the company's next generation high-NA technology. As a result, full-year sales are expected to reach around 28 billion euros, which was in line with previous guidance. But a more gradual recovery than previously anticipated in parts of the semiconductor market beyond AI means that guidance for 2025 sales has been lowered from 30 to 40 billion euros to 30 to 35 billion euros. An interim dividend of €1.52 was declared, and the shares were down 15.6% in early trading. In terms of valuation, the group has a market cap of 284 billion euros and trades at 29.5 times forward earnings, compared with a 10-year average of 29.9, with a yield of around 1%. I thought these results were, I think, in the sector, with these results, it is a bit disappointing. And of course, you can't compare Nvidia with ASML, but I think with the revenue growth at under 12%, it is a bit disappointing in that market. I know they do point to some recovery in end products like PCs, mobile phones, and non-AI specific servers taking longer than they expected to gather pace. A bit disappointing on that. The other side of the business that I think is quite interesting, and I suppose gives it a bit more stability to the earnings, is that they've got the service side of the business, which is involving fixing and upgrading machines, and the recurring revenue and growing revenue stream from that does make up around 20% of the current sales. There is as well the geopolitical tensions, and I believe if you're looking at sort of trade issues between, and I suppose general geopolitical issues between China and the US, then that has been a focus. I believe there were murmurings from China whether they would, or companies in China might acquire the group a few years ago, and government stepped in to stop that. I think it's a business that I'd like to research more, and I appreciate it's got a fairly top evaluation for the figures that it's put up. But depending on what it's got there and potentially some of the patents that it's got, it may be reasonable, but I think it does require further research. Sam, what are your thoughts on ASML and these results?
I think it's an interesting business. It looks like it's more of like a picks and shovels play on semiconductors, which I do find quite attractive. I mean, we're not that hot on our semiconductors, mainly because we don't have them listed really in the FTSE. We used to have ARM, didn't we? But that's now gone over to America as well. But
And at a much, much bigger valuation, I would point out.
yeah, which kind of justifies why. So we don't really have many of our own. We do cover Nvidia fairly regularly, and I know Nvidia is a much, much bigger business, but Nvidia trades at about the same PE multiple, and it's growing over 100% a year. And I think maybe that's discounted slightly in the PE because it's growing off such a large base and the market's not really sure how sustainable it is. But even still, like you say, for a business that's growing sort of 12% a year, I just wouldn't pay 30 times earnings for it. That being said, it is in an industry that in the long term you'd expect to do very well. Obviously, it's listed in the Netherlands, so you'd hope it might at some point have a more reasonable valuation than some of its US peers, but I think it's a business I'd be interested to cover again in maybe 6 or 12 months and hope it's come down a bit more in price, because I think it is a business I'd potentially be interested in just given how attractive the industry is. But I also think the industry is very, very cyclical. And also as well, you've seen, I know we don't really cover it on the show, but you've seen what's happened to like Intel, for example, whereas, if you're selling sort of the machinery or whatever it is that they use, I guess that's more attractive. But even then, it brings me quite nicely onto my point that I think I'd have some issues understanding it, because how do I know that that technology won't have the same issue that Intel has had and it's going to continue to be, a market leader, or that the technology won't change in a way where its machines and expertise is somewhat superseded, like with Intel. But yeah, I think it's an interesting business and I would probably be interested in covering it again.
Yeah, no, fair enough. And it is worth pointing out when you say, Intel and technology being superseded, ARM is now bigger than Intel.
Is it?
Yeah.
Oh, that's very surprising.
I'm not sure. I'll have to check the market cap, but I think it's getting on for twice the size.
That's incredible. But I mean,
Yeah.
it's more Intel's performance than ARM's. I know ARM's doing
Yeah.
very, very well, but
Yeah, and
Intel is also doing well.
Nvidia wanted to buy ARM, but it was competition issues that that came in on that.
I think Nvidia's so big at this point, it doesn't really matter who they swallow up. But I don't think the competition authorities agree with us. But
Okay,
should
right.
we move on to Mony Group?
Absolutely. So,
So Mony Group, it's a business that I've owned it in the past, and I've recently become a shareholder again. So Mony Group, they are basically moneysupermarket.com, the price comparison website. They have come out with a Q3 trading statement. And firstly, if we split them by segments, Insurance business grew 1% for the quarter as they maintained discipline in a competitive pay-per-click market. As a reminder, Q3 2023 saw car insurance premium growth reaching peak levels, creating a tough prior year comparator. In the money segment, credit card switching was strong. However, as expected, current account switching remained soft due to the limited availability of attractive offers during the quarter. As a result, money revenue was 4% lower in Q3. Home services was 8% lower, primarily due to soft demand from customers in broadband and fewer compelling new handset launches in mobile during the period. In travel, performance was predominantly impacted by lower conversion in car hire, which resulted in revenue being 15% lower in the quarter. And cashback grew 2% in the period, driven by continued member growth through the year and strong performance in insurance within cashback. Said that Super Save Club, their member-based loyalty and rewards program within Money Supermarket, continues to grow, and they're very pleased with the progress. They now have over 750,000 members and have increased the available products to include single-trip travel insurance. In terms of the outlook, they've said that their solid performance and continuing strategic progress gives the board confidence that the group will deliver full year 2024 results in line with current market expectations. As previously stated, they continue to expect no material energy revenue in 2024 financial year. I do think the market is starting to move in a direction though where that will hopefully switch back on at some point, and when it does, that's probably a 20% increase in revenue without them really having to do anything and not that much of a huge increase in costs. That being said, if we pretend that energy won't come back at all, it is currently trading at a PE ratio of 12.46 and has a dividend yield of just over 6%. And the shares are actually down from, well, in the last few months, they're down from about 220 and they're now at 196p. So they're only down about 10%, 15% in the last few months, but they've been a lot higher. They've been as high as £2.86 in the last 12 months. This is going back to like 2018, but they've actually been over £4 a share very, very briefly. So they're trading at half that valuation. But yeah, as a shareholder, I'm pretty happy with these results, pretty steady. Some of it was slightly disappointing, but then I think that's more than offset by the valuation and the fact that the energy business is still to come back. But a PE of 12 and a 6% dividend yield, I'm quite happy to just hold it and take the dividends, really. So yeah, I'm pretty happy with it, even though it wasn't an outstanding trading update. What about you, John?
Yeah, I think they were sort of average results, but I think so far and over the last couple of years, particularly after energy, went, and that was compared with the market previously, that was pretty unexpected. But they've done very, very well, and I don't think at that valuation you go too far wrong. They do have an impressive ratio when it comes to return on capital employed, and it seems like a very well-run business. Certainly one that I've begun to appreciate more and more as we've covered it over the years. Don't know whether I buy shares just yet, but it's certainly up there on my radar.
Shall we move on to our final European business of the week then?
Yes, absolutely. So again, I think it would be fair to say that it is a favourite of the show. It's Nestle, which has numerous household brands. We like it very much. Issues that we've had with it in the past have been its premium valuation, and it's certainly been more expensive than some of its UK peers, namely Unilever. However, they've come out with their Q3 trading statement, and the group have reported sales of 67.1 billion Swiss francs over the first 9 months, down 2.4%. And organic growth was positive at 2%, with 0.5% from volumes and 1.6% from pricing, driven by coffee, pet care, and confectionery. Management called out a difficult consumer environment and expects further inventory reductions from its consumers in the final quarter. As such, full-year guidance now points to organic sales growth of around 2%, previously at least 3%. Underlying trading operating profit margin is expected to be around 17%, whilst underlying earnings per share are broadly expected to be flat. And the shares were down 2.3% in early trading. In terms of valuation, Nestle has a market cap of 225 billion Swiss francs and trades at 17 times forward earnings, compared with a 10-year average of 21.5, with a dividend yield of 3.8%. I think these results, as we saw last time, are disappointing. They have historically, and when I say historically, over the last couple of years, significantly outperformed Unilever. And that has been reflected in the price. Unilever's been on a bit more of a recovery recently, and things are certainly moderating at Nestle. I think this valuation is still on the higher side, and you can to a degree, I think, give it the benefit of the doubt. It has performed very, very strongly. It also has some fantastic brands, including Nespresso and Nescafe. It's difficult to know, and it's a bit like LVMH in that sense, at what is a fair price for Nestle, given its historical performance. I probably wouldn't pay 17 times forward earnings for it. I'm quite pleased with how Unilever's doing in terms of the recovery, and that's where I would leave my money. Would I like to have Nestle in my portfolio longer term? I probably would. It's interesting to keep an eye on and just see how far things go. But with a quality stock like this, if things start to improve, you see that valuation will likely very quickly revert to what it has been. I appreciate it's not like the tech stocks where it will be significantly higher, but going back more towards its 10-year average. As I say, I'll probably leave things are where they are at the moment with Unilever and continue to follow with interest with Nestle just to see how low things do go. Sam, what are your thoughts on these results and Nestle as a company?
Is there a price at which you would buy it? I know there obviously is, but
there is.
How close is it?
I think if we got down to sort of 15, I think that would probably be it for me.
So we could be there in 6 months.
We could be, and it's one of those companies that's higher up on the list than it ever has been before.
I don't get, so if the organic growth was positive, is this just, why is the sales down? Is that exchange rate differences?
I think it is.
Yeah, it looks like the Swiss franc has done quite well, even over the past 5 years, actually, compared to the euro, which I'm assuming I guess a lot of the revenue is actually going to be in dollars, isn't it? Because it's global. But yeah, if the Swiss franc's doing well, that's probably it. But I think the underlying figures are not terrible in terms of volumes and prices are both up organically anyway. But it's not terrible organically. It's a really good business. It's a business we've covered for years, and it's been around 25 times earnings. And I think we're now starting to see it, like you say, go more towards a level at which you'd be interested. I don't think I'd want it at 15 times earnings, but I think you can definitely make a strong argument for it. But yeah, it's disappointing, but it's had a cracking 2 or 3 years since we started covering it. So I think it's maybe allowed a bit of a wobble, and it's not actually declining. So I think that's probably the main thing. But yeah, hopefully we're here in 3 or 6 months and it's at a price where you can actually dip your toe in. But yeah.
Yeah, no, absolutely. I mean, the share price is the cheapest it's been in 5 years.
But it's still not down that much. It's like down like 15%, isn't it?
Yeah, I mean, it's all relative, but
that's the problem with these quality businesses. They tend not. I mean, unless you get a COVID or something like that, it's rare we're going to cover it unless there's a disaster and it's down 25-30%. So
it helps you sleep.
It does, yeah, which is part of the appeal, I guess.
Yeah, absolutely.
So should we move on to a business that has been more volatile recently?
Yeah, no, absolutely, Sam. Tell us about Netflix.
In this case, it has, in the past 12 months at least, been volatile in a good way because the shares have almost doubled. And actually, I think, yeah, it's actually a 3x in the past 3 years, Netflix.
Gosh.
That is after quite a significant pullback. So it was over $600 a share, and then it pulled back to about $200, and it's now at sort of 769. So it's gone back to its previous peak. But we've covered it for a couple of years where it was not clear what the direction of the business was going to be, and it's obviously had to deal with Disney coming in and a lot more competition, like Paramount, for example. So Netflix have come out with their third quarter results, and revenue was $9.8 billion, which was up 21% ignoring currency moves, and that was helped by 5.1 million net new paid subscribers, which was down from the 8.8 million added in the same period last year, but better than the 4.5 million markets were expecting. Operating income rose 52% to 2.9 billion, with margins improving from 22 to 30%, both better than expected. Free cash flow rose 16% from last year to 2.2 billion, and net debt moved from 7.4 to 6.8 billion over the quarter. For the fourth quarter, revenue is expected to grow 15% or 17% if ignoring currency movements, with net new paid subscribers to be higher than the quarter just ended. Full year revenue is now expected to grow 15%, and that was previously a range of 14 to 15%. The shares rose 6.7% in pre-market trading. Revenue is still expected to grow double digits in 2025. And in terms of valuation, it now trades at a forward P of 31, and that compares to a 10-year average of 94. But I think because of the journey it's been on, and it probably has moved away from being as much of a growth stock, I don't think that 10-year average is really any use now, because I think it's a very different business than it was 5 or 10 years ago. I think for me, these are just an excellent set of results, but all the concerns that I had when we were covering it a couple of years ago are probably still there. I think it is going to be quite a cyclical business where, depending on how hot the content is, whether they've got a Squid Game or something like that, you'll get quite a lot of churn. That being said, it's generating a lot of cash. It's got loads of money to pay for top quality content. I think they'll do pretty well, but yeah, how big can they get? It's already pretty saturated. I don't think they've got as much capacity to raise prices as they did 10 years ago because of the competition. So I think that's a bit more tricky. So I think really the main way to increase revenue is to add more subscribers. I don't know at what point they hit saturation, but at a forward P of 31, I think it's pretty expensive. I also think that really, if you think it's a good business now, I would ask why you weren't buying it 12 months ago or 18 months ago when it was down significantly, and it was very easy to come up with all these concerns, which I do think are still there. I think this is going to be a business that does swing quite wildly, but fantastic results. I think the management are doing an excellent job with it. I think they've weathered the storm very well, but for me, I just have too many concerns with it. I wouldn't want to touch it at a P of 31. What about you, John?
Yeah, no, I also wouldn't want to go near it at the current price. I think as well, it's very, very competitive market. You're up against big players like Disney. A few years ago, and we are going back a few years now because Disney Plus has been out, there was a lot less competition. And I think we've seen that the industry can be cyclical, and also that it's so expensive to produce the content. And that is something that Netflix have to continue doing. And again, I suppose the other question is, with the current valuation, how much growth is there to come? I think these results are excellent though, and the company's doing really well. So it's just not one for me to invest in, I think.
So in that case, of the 6 businesses we've covered this week, LVMH, Whitbread, ASML, Mony Group, Nestle, and Netflix, which do you like the most and which do you like the least?
Tricky. I would probably say that LVMH and Nestle are up there. Historically, they've been ones that I've really appreciated, and then it's just been coming to terms with those valuations, which have been quite toppy. If I were to pick between the two, I would probably go with LVMH. And then at the bottom, possibly go for Netflix. I think ASML it's one that I would need to know more about. And I think knowing how much of a moat it's got, it's probably a little bit early to call on that. If I exclude that, I would probably go with Netflix, I think. What about you?
So I think for me, it's mainly a valuation thing, but for me, my favorite would be Mony Group, which is good because it's the one I own. If I exclude that, I think maybe Whitbread actually.
Okay,
I
interesting.
think although it's in a horrible industry, I think they have operated so well over the last couple of years, and I do think there is a good opportunity in Germany. Whereas I think there's obviously some fantastic businesses that we've covered this week. LVMH and Nestle are both great businesses that I think a lot of investors would love to own with some of those brands, but neither of them's really at the price at which I'd really want to pull the trigger. Least favorite, probably ASML, but that's mainly because it's a business I don't understand. I've got concerns about the valuation anyway, but I'd need to cover it a few more times. And even then, it might still be in the too hard pile.
Fair enough. Okay. Well, thank you very much for listening, and we will see you again next week.
See you next week.
Thank you for listening to The Investor Way. To get in touch, please follow us on Twitter at TIWTweets. This podcast is for entertainment purposes only and does not constitute financial advice. Neither Sam nor Jonathan are financial advisors. For investment advice, please consult professional advisors.